Hi all, we are going to discuss types of risks today. The first one is liquidity risk. It is inability to obtain funds at reasonable rates for meeting cash flow obligations. So if they are unable to meet cash flow obligations, so cash flow obligations means that inward and outward cash flow. That is, if let us suppose FDs, loans, those are all comes under this cash flow obligations. So in this liquidity risk, there are again three types. First one is funding risk. Funding risk means it is risk of unanticipated withdrawals and non-renewal of FDs, which are raw material for fund-based facilities. So unanticipated withdrawals means if you are that means that before maturity date. So sometimes people may withdraw FDs in one shot. So if there is any rumors about the reputation of a bank, so people will go to the bank and they will all withdraw at a time. So this is called as unanticipated withdrawals. In this type, so funding risk will come. So this funding risk will lead to liquidity risk. And next one is time risk. It is a risk of non-receipt of expected inflows from loans in time due to high rate of NPAs, which will create liquidity crisis. So if loans are not paying in time, so EMIs are not coming to the bank, so then it will cause liquidity risk. So this type of liquidity risk is called as time risk. And next one is call risk. It is a risk of crystallization of contingent liabilities. So that means that, so here also the callable bonds are prematuring. This type of risk is called as call risk. Next one is interest rate risk. Interest rate risk is the risk of loss due to adverse movement of interest rates. That means if there is a adverse movement, means worst movement of interest rates, so then it is called as interest rate risk. So usually it is 5 types. So in this first one is gap or mismatch risk. Gap or mismatch risk means it is a gap between maturities of assets and liabilities. Long-term loans are funded by short-term deposits. After maturity of deposits, these liabilities are get repriced and gap of interest rates between assets and liabilities may become narrowed, thereby reduction of profits. So we are giving, let us suppose, loans for cheaper rate, but for FDs, let us suppose if we are giving more interest for FDs, then it is a interest rate risk. So the gap between the interest rate of FDs and interest rate of loans is called as gap risk or mismatch risk. So this will lead to interest rate risk. Next one is basis risk. Change of interest rates on assets and liabilities may change in different magnitudes, thus creating variation in net interest income. So basis risk means basically it is a change in interest rates on assets and liabilities. So usually it will create net variation in net interest income. Next one, yield curve risk. So yield is internal rate of return on securities. Higher interest rate scenario will reduce yield and thereby reduction in the value of assets. So adverse movement of yield will create effect in net interest income. So it is also lead to interest rate risk. Next one, embedded option risk. So adverse movement of interest rate may result into prepayment of CC or DL and TL. It may also result into premature withdrawal of TDs and RDs. This will also result into reduced net interest income. This is called as embedded risk. So embedded risk will linked with premature withdrawal of TDs and RTs. Next one, reinvestment risk. It is uncertainty with regard to interest rate at which future cash flows could be reinvested. So moving to next one, market risk. Market risk is the risk of reduction in market to market value of trading portfolio, that is equities, commodities and currencies etc. due to adverse market senses. Market risk comprises of price risk occurs when assets are sold before maturity, bond prices and yield are inversely related, internal rate of return affects the price of instruments, price of other commodities like gold etc. is also affected by the market trends, forex risk are also market risk, liquidity risk or settlement risk is also present in the market. So if there is an adverse movement of market sensex, it will lead to market risk. In this, forex risks also comes under this market risk. So forex means it is depend upon market. So this also comes under market risk. So moving to next one, credit risk or default risk. So credit risk is the risk of default by a borrower to meet commitment as per agreed terms and conditions. Means if the borrower is unable to meet his or her obligation, that means that he has to pay the EMI. So if he is not satisfying his obligation, that means he is not paying in time. So then it will lead to credit risk. So in these two types are there, counterparty and country risk. Counterparty means the borrower. This includes non-performance by the borrower due to his refusal or inability to pay. That is called as counterparty. So counterparty means it is borrower. Next one, country risk. When non-performance of borrower arises due to constraints or restrictions imposed by a country. Sometimes there may be impositions by the country. So moving to next one, operational risk. So operational risk is arises due to inadequate or failure of internal process. So this may be due to system failure, or it may be due to any frauds, it may be due to any failure to comply the laws. So this will comes under operational risk. So moving to next one, other risk, that is strategic risk, reputational risk, system risk and settlement risk. So these are the other main types of risks. So moving further, some previous questions regarding risks. Prepayment of loan amount or withdrawal of deposit amount will add to embedded option risk. So reinvestment risk means when interest rate at which the future cash flows can be reinvested are uncertain is called as reinvestment risk. Mismatch in cash flows and movement of interest rates also lead to reinvestment risk. So all options are correct. The most important and well pronounced risk in treasury is market risk. So treasury means it is always related to market. So usually Sensex, so it is market risk. Risk associated with changes in credit profile of the borrowers and counterparties is called credit risk.